95% of companies shouldn't raise venture capital, but they try anyway, and it destroys them. So I'm Samuel from IRC Partners. Between our team of advisors and global syndicate, we've raised over $37 billion in venture capital funding over the years. In the next 16 minutes, I'm going to show you exactly how venture capital funding works, who VCs are, why you should raise from them, how much to raise, what it actually costs you, and most importantly, whether venture capital funding is even right for your company. By the end, you'll know if you should pursue venture capital funding or take a different path. Venture capital is when institutional investors give you money in exchange for equity ownership in your company. Here's how it actually works. A venture capital firm raises money from limited partners. Those are typically wealthy individuals, pension funds, endowments. The VC firm then invests that money into high-growth startups. They're betting that one or two of those startups will return 10 times, 50 times, we call it X, so 10x, 50x, or even 100x their initial investment. That is the entire game in a nutshell. And they know 7 out of 10 investments are going to fail, but the winners have to win big enough to cover all of the losers and still generate massive returns for the investors. This is why venture capital funding isn't for lifestyle businesses. It's not for companies that want to grow slowly and steadily. Venture capital funding is for companies that want to dominate a market, scale fast, and exit big. If that's not you, that's okay. There are other ways to raise capital, but if you want to build the next unicorn, venture capital funding is the path. And here's what most CEOs get wrong about venture capital funding. They think it's just about the money. Well, it's not. The money is actually the least important part. Let me show you what I mean by this. Not all venture capital funding is the same. There are different types of VCs, and understanding this will save you months of wasted pitching. Type 1, early stage VCs. These firms invest in pre-revenue or early revenue companies. We're talking seed rounds, Series A. They write checks from $500,000 to roughly $5 million. Examples, first round capital, initialized capital, founder collective. These VCs care about the team, the vision, and early traction. They don't need to see profitability, so to speak. They want to see that you can execute. Okay, type 2, growth stage VCs. These firms invest in companies that already have product market fit and are scaling. Series B, Series C, Series D. They write checks from $10 million to $100 million or more. Let me give you some examples of those. Insight Partners, General Catalyst, Excel. These VCs care about metrics, revenue growth, customer acquisition cost, lifetime value, unit economics. They want to see that you've figured out the business model and now you just need capital to scale. Type 3, mega funds. These are the big names: Sequoia, Anderson, Horowitz, Benchmark. They invest at every stage, but they're extremely selective. They write checks anywhere from $1 million at seed stage to $500 million at late stage. And getting into a mega fund is like getting into Harvard. It's hard, but it signals to the market that you are legit. Type 4, corporate VCs. These are venture capital arms of big companies. Google Ventures, Salesforce Ventures, Intel Capital. They invest venture capital funding with a strategic angle. They want to invest in companies that could become partners, customers, or maybe acquisition targets. Here's what we tell our clients. Don't pitch every VC. Pitch the VCs that invest at your stage, your industry, at your check size, your round size. If you're raising a $2 million seed round in fintech, please don't pitch a growth stage healthcare VC. You're wasting your time, you're ruining the market, and everybody's going to be grumpy. But here's the question. When should you actually raise venture capital funding? Because timing is everything. Most founders raise venture capital funding way too early. They pitch VCs before they're ready, and they get rejected, of course, over and over again. And here's when you should raise venture capital funding. Signal 1, you have product market fit. This means customers are actively using your product and paying for it. Sounds simple enough. Not just saying they like it, actually paying. If you have high retention, strong net promoter scores, and customers are referring other customers, you've got product market fit. VCs don't want to fund you to find product market fit. They want to fund you to scale product market fit. Capiche? We had a SaaS founder a while back pitch 30 VCs at $50,000 in annual recurring recurring revenue, ARR. He got rejected by all 30. Why? Too early. He didn't have product market fit yet. He came back 18 months later at $500,000 ARR with 95% retention and 20% month-over-month growth. Same VCs, different story. He raised $3 million in venture capital funding in 6 weeks. Okay, signal 2, you need capital to scale. If you can bootstrap to $10 million in revenue, by all means do it. Keep 100% ownership of your company, but if you're in a competitive market and you need to move fast, venture capital funding makes sense for you. And we see this in markets like SaaS, fintech, e-commerce, real estate developments, infrastructure, energy. If you don't scale fast, your competitor will, and they'll crush you. Okay, signal 3, you have a clear path to $100 million plus. VCs, they need big exits. They're not interested in $10 million exits. They need $100 million, $500 million, $1 billion exits. Like my buddy in the Bay Area just had a $946 billion exit just last month from Goldman Sachs. If your market isn't big enough to support a $100 million plus company, don't raise venture capital funding. You'll disappoint your investors and yourself. So here's the uncomfortable truth. Most companies shouldn't raise venture capital funding at all. They should bootstrap, take debt, or raise from angels. Venture capital funding is for companies that want to go big or go home. If that's not you, absolutely, that's okay, but don't waste time pitching VCs just to get disappointed later. Remember what I said at the start. Venture capital funding isn't for everyone. This is why. Here's the formula we use to calculate how much venture capital funding to raise. 18 to 24 months of runway plus growth capital. Now, let me break that down. You need enough capital to operate for 18 to 24 months without having to raise again. This gives you time to hit milestones, to prove traction, and raise your next round at a higher valuation. If you raise for 12 months, you're in trouble. You'll spend 3 months raising, which means you only have 9 months to execute. That's not enough time. If you raise for 36 months, you're giving away too much equity. You don't need that much capital. 18 to 24 months is the sweet spot for venture capital funding. On top of runway, you need capital to grow. Hire sales reps, build marketing campaigns, expand to new markets. Now here's a real example. A SaaS company raising Series A venture capital funding. Current burn, $100,000 per month. 18 to 24 months of runway, $1.8 to $2.4 million. Growth capital for sales, marketing, product, $2 million. Total raise, $4 to $4.5 million. That's how you calculate it. Here's what we typically see for venture capital funding by stage. Seed, $500,000 to $2 million. Series A, $2 million to roughly $15 million. Series B, $15 million to say $50 million. Series C and beyond, $50 million plus. These aren't hard set rules. They are guidelines or guardrails, so to speak. Your amount depends on your burn rate, your growth rate, and your market. And we've helped companies raise $500,000 and we've helped companies raise $2 billion in venture capital funding. The process is the same. Know your numbers, know your milestones, raise what you need. But here's the part most founders mess up, and hopefully you won't. They don't know how to find the right VCs. Now, let me show you. Cold pitching VCs does not work. Your email goes straight to spam. Here's how to actually get venture capital funding. Step 1, build your target list. Use Crunchbase or PitchBook or AngelList to find VCs that invest at your stage, your industry, your geography, your round size. Filter by stage. Seed, Series A, Series B, industry, SaaS, fintech, healthcare, energy, whatever. Check size. Match what you're raising. This cuts your list from 5,000 VCs to roughly 50 really targeted relevant VCs. Now, step 2, research their portfolio. Look at who they've invested in. Are these companies similar to yours? Are they competitors or adjacent? If a VC invested in your competitor, they probably won't invest in you. But if they invested in an adjacent company, they're interested in your space. Now, let me give you an exact example of that. We were doing a raise for an oil and gas energy company, and it turned out there was a VC that we wanted to go after that funded a very similar company, except they did things slightly different. When we spoke to them on the phone, they were very excited because the company that they funded didn't do exactly what our company was doing. It would be a great bolt-on investment for them. It makes sense? Step 3, get a warm introduction. We see this all over. I say it in almost every video. This is the most important step. You need someone the VC knows and trusts to introduce you, like my buddy who just exited for close to $1 billion. Who can introduce you? Your existing investors, other founders in the VC's portfolio, portfolio, maybe advisors who know the VC, customers who are well connected. Here's a real example. We had a founder who wanted to pitch Sequoia. He didn't know anyone at Sequoia, of course, but one of his customers was a former Sequoia portfolio CEO. Well, that CEO made the intro. The founder got the meeting, and he raised $10 million in venture capital funding. So here's the truth about warm introductions. Most founders don't have access to the right networks. And no matter how hard you try, you probably never will. Through our embedded capital partner model, we work with 77 investment banks and 307 institutional allocators worldwide. At a recent family office conference in Fort Lauderdale, Florida, allocators that are managing $17 billion in deployable capital asked us for quality deal referrals. This is huge. This is demand inversion, capital chasing our firm, not the other way around. And that's what happens when you're equity aligned and selective. They know we bring great deals and they want a piece of it. Okay, step 4, pitch with traction. When you get the meeting, lead with traction, revenue, growth, customers, metrics. Don't start with your vision. We're at $1 million annual recurring revenue, growing 25% month over month with 90% gross margins and 40 enterprise customers. We're raising $5 million in venture capital funding to scale sales and expand to Europe. Now that gets attention. So here's what separates founders who get venture capital funding from founders who don't. Preparation. Founders who raise capital have done their homework. They know exactly which VCs to pitch. They have warm intros with them. They have traction. The founders who don't raise capital, they spray and pray. They cold email 500 VCs. They use some 30-year-old fancy sales kid who thinks he knows the capital market, and they blow the deal. They fail. Don't be that founder. VCs evaluate hundreds of deals per quarter. They fund maybe 1% to 2% of what they see. And in this world, you really got one shot to do it right. I always say one shot to raise correctly. Do not blow it. And here's what separates the 1% that gets venture capital funding from the 99% that don't. Factor 1, the team. VCs bet on people, not ideas. They want to see that you can execute. What they look for? Relevant experience. Have you built something before? Domain expertise. Do you understand this market? Coachability. Can you take feedback? Grit. Will you keep going when things get hard? Real example, we had 2 founders pitch the same idea. Founder A is a first-time entrepreneur with no industry experience. Founder B sold a company for $50 million in a previous exit and spent 10 years in the industry. Well, founder B gets the venture capital funding every single time. Factor 2, market size. VCs need big markets, room to grow. If your total addressable market is $100 million, they're not going to be interested. They need billion-dollar markets. Why? Because even if you capture 10% of a $100 million market, that's a $10 million company. That's nice for a lifestyle company, but VCs can't make money on $10 million exits. But if you capture 10% of a $10 billion company, or a $10 billion market, I should say, that's a $1 billion company. Now we're talking. Okay, factor 3, traction. This is the single most important factor. Do you have customers? Are they paying? Are they staying? VCs want to see revenue growth of 20% plus month over month recurring revenue. Call it MRR, monthly recurring revenue. High retention of 90% plus for B2B SaaS companies. Strong unit economics with lifetime value and customer acquisition cost ratio of 3 to 1. Or better than 3 to 1 if possible. If you have these metrics, you'll get venture capital funding. If you don't, you won't. So factor 4, differentiation. Why are you different? Why can't someone else do this? VCs, they want to see a defensible moat, network effects, proprietary technology, brand, something that makes you hard to compete with. If your business can be copied in 6 months, you are not getting venture capital funding. We've seen thousands of pitches here at the firm for venture capital funding over the years, and the ones that have succeeded have all 4 factors. Great team, big market, real traction, clear differentiation. If you're missing one, fix it before you pitch, please. Now remember what I said at the start. Venture capital funding is a partnership that defines the next 5 to 10 years of your company, and that's because once you take venture capital, you're locked in. You can't just cash out and move on and say sayonara. You're building toward an exit. And acquisition or an IPO. If you're okay with that, venture capital funding is incredible. If you're not, consider other options. All right, let's wrap this up. Here's what you need to know about venture capital funding. Venture capital funding is equity investment from institutional firms betting on high growth companies. There are different types of VCs. There's early stage, growth stage, mega funds, and corporate VCs. Pitch the ones that match your stage and industry. Raise venture capital funding when you have product market fit. You need capital to scale and you have a clear path to $100 million plus. Raise 18 to 24 months of runway plus growth capital. Don't raise too little or too much. Find VCs through warm introductions, please, not cold emails. Research their portfolio, do your homework, lead with traction. VCs look for great teams, big markets, real traction, and clear differentiation. Here's the bottom line. Venture capital funding isn't for everyone, but if you're building a high growth company that needs capital to absolutely dominate a market, it's the best path possible. Here's what to do next. Number one, if you're specifically looking to raise a Series A round, I made a complete guide for you. Watch our video titled Series A Funding. I'll put a link to it somewhere up here. It's called Series A Funding Complete Guide for Founders in 2026. Link in the description below as well, but you can watch it here. Now that video breaks down everything you need to know about Series A venture capital funding. Now, number two, download our free VC pitch template. It's the exact deck structure we use to help companies raise venture capital funding. The link will be free for you in the description below as well. And number three, if you're raising $5 million or more in the next 90 days, I'd encourage you to book a strategy call with our deal team. We work with anywhere between 5 to 7 companies per quarter. We have one upfront engagement fee that covers every single round you raise. Differentiates us from absolutely everyone in the market. Why? Because there's always a next round. Series A, Series B, Series C, everything beyond. Most bankers, they're gonna bill you every round. We charge once and done, never to come out of pocket again. We also take a 2 to 4% equity in every single deal. And that means we're on your cap table. Why? Because raising capital happens between rounds. We all know this. Your outcome is our outcome. And if you're serious about this raise, let's see if we're gonna be a fit. Links below. And if this was helpful, go ahead and hit that subscribe button below because we drop new capital raising videos, structures, and guides every single week. I'm Samuel from IRC Partners. Now go raise that venture capital funding and get it done.